Most people believe that investing in the stock market is only for the wealthy, for people who already have thousands of dollars sitting in their bank account. But here's the truth: you don't need to be rich to begin. You can actually start with as little as $100. And that one step, that one decision, could completely change the way you build your financial future. In this video, I'll show you how to take your very first $100 and turn it into the foundation of your wealth-building journey. By the end, you'll know not just where to put it, but how to keep growing it steadily over time. Before you even place your first investment, you need to stop and ask yourself, why am I investing? This step might seem small, but it's absolutely critical. Are you investing for retirement? Do you want to grow your wealth for a future home, or maybe just to learn the basics and gain experience? When you're starting with $100, it's not about becoming rich overnight, it's about building strong financial habits that will last a lifetime. Your first $100 is a symbol of discipline, and once you create the habit of investing, adding $100 every month will become second nature. This is how you set yourself up for long-term success. Let's talk about one of the most powerful forces in finance: compound interest. Imagine planting a tiny seed. At first, it doesn't look like much. But if you water it regularly, it grows into a tree. That's exactly how compound interest works. Even if you only start with $100, over time, your returns generate more returns, and that cycle repeats again and again. Albert Einstein even called compound interest the eighth wonder of the world. Why? Because it allows ordinary people with small amounts of money to build extraordinary wealth, simply by giving their money time to grow. Now, let's get practical. If you only have $100 to invest, where should you put it? The smartest option for most beginners is an index fund or an ETF. These are investment vehicles that pool together hundreds of different stocks. So instead of putting all your money into one risky company, you're spreading it across the entire market. For example, an S&P 500 index fund gives you exposure to the 500 biggest companies in the U.S.A., from tech giants to healthcare leaders. This diversification reduces your risk while still giving you solid returns. Think of it as buying a basket instead of just one fruit. You might be thinking, but I can't afford to buy shares of Apple or Amazon with just $100. And that's where fractional shares come in. Thanks to modern platforms like Robinhood, Fidelity, or Vanguard, you no longer need to buy a full share of a company. Instead, you can invest in just a portion of it. That means with only $5 or $10, you can actually own a piece of Apple, Tesla, or Amazon. This feature completely removes the barrier to entry and makes investing accessible to everyone, no matter your budget. With just a phone and $100, you can own a piece of the world's most powerful companies. Let's run through a real example. Imagine you put your $100 into an S&P 500 index fund. Historically, the S&P 500 has delivered an average return of about 10% per year. That means your $100 could turn into $110 in a year, and then those $110 could become $121 the next year, and so on. The real magic happens when you keep adding to it. If you invest $100 every single month for 10 years, and it grows at 10% annually, you won't just have $12,000, you could have more than $19,000 thanks to compound growth. That's the difference between just saving money and actually investing it. Here's the catch though, investing one time is not enough. Many beginners put in $100 once, expect it to grow massively, and then stop. But the real power comes from consistency. Imagine planting a seed but never watering it up, it won't grow. Investing is the same. If you invest consistently, whether it's $100 a month or even $20 a week, you're building momentum. Over time, this habit becomes automatic, and that's when your wealth starts to take off. It's not about how much you start with, but how often you keep going. Now let's address a big mistake beginners make, trying to time the market. Many people wait for the perfect moment to invest, or panic and sell when prices drop. But here's the reality: the stock market has always gone up in the long run. Every dip, every crash, has eventually recovered. If you panic and sell, you lock in your losses. But if you stay consistent and keep buying, dips become opportunities. Think of it like shopping. When prices drop, you're actually buying stocks on sale. That's how the best investors grow their wealth faster. But let's be clear, investing always comes with risk. That's why you should avoid high-risk bets or get-rich-quick promises. Don't put your $100 into random penny stocks or trendy schemes. Instead, stick to proven strategies like index funds, ETFs, or well-established companies known as blue chips. Remember, your goal isn't to double your money overnight, it's to build habits and let time do the heavy lifting. Slow and steady always beats fast and risky when it comes to long-term investing. So here's the bottom line: starting with $100 might feel small, but it's not about the size it's about the start. Every successful investor, from Warren Buffett to today's everyday millionaires, began with their very first investment. What matters most is that you take action, stay consistent, and let time work its magic. Don't wait for the perfect moment. Don't tell yourself you don't have enough. You do. Start with $100 today, and years from now, you'll look back and realize that one small step was the beginning of your financial freedom.